Good morning, everyone. My name is John Doberstein. I'm Senior Editor at No-Till Farmer. Thanks for joining us today for our webinar with ForGround by Bayer titled The Farm Income Outlook and Boosting Carbon Revenue Opportunities. Our presentation today will be featuring Dr. Alejandro Plastina, Director of the Rural Farm Finance and Policy Analysis Center at the University of Missouri, who will discuss the income outlook for 2025 and the uncertainties around those projections. We'll also hear from Dr. Austin Omer, who is a Sustainable Systems Agronomist for ForGround by Bayer. The team at ForGround will give an overview of the carbon industry and reveal how attendees can earn revenue through the Bayer Carbon Program and why now is the best time to enroll. Before we get started with the presentation, I'll have a couple of housekeeping items to go over. On your screen, there is a control panel with a Q&A icon. You can submit questions there at any time during the presentation, and we'll take those at the end of the presentation. We are recording today's session in the event you want to go back and watch it or share it with anybody. So with that, let's turn the show over to Dr. Alejandro Plastina.
Good morning, everyone. Thank you for this invitation to discuss the U.S. farm income outlook. Most of the projections I will be using today are from FAPRI, the Food and Agricultural Policy Research Institute at the University of Missouri, and RAF, the Rural and Farm Finance Policy Analysis Center that I direct, is a sister organization of FAPRI, with the main difference that RAF has been launched to fill a critical gap in agricultural finance and policy analysis by focusing on individual states and geographic regions rather than national, more aggregate kind of analysis conducted by FAPRI-MU. And the goal is still to provide objective analysis and data-driven insights to stakeholders in policy and industry. Now, we have to acknowledge that this RAF, this Policy Analysis Center, is supported by cooperative agreements with the USDA's chief of the Office of the Chief Economist. So we are very happy to present this webinar and invite you to go online to our website, ruralandfarmfinance.com, and download the outlook for your own state. As you can see, we've completed recently a number of projections for a number of states, focusing on farm income outlook in 2024 and 2025. So what can we say about 2024 and, more importantly, 2025? Well, if we look at field crops, that's where the most of the pain can be expected, right? And not just in 2025, but maybe in the medium term for a number of years, because we're expecting lower prices and some costs remain high. On the cattle sector, things are much better. There's limited supply, high prices, and right now low feed costs that really help with the profitability in that sector. In general, we can say that we can expect lower net farm income in 2024 and 2025 than what we've seen in recent years. And currently, there's a big question mark on the policy outlook. And we'll revisit some of these concepts at a later stage. Let's start by looking at the U.S. corn supply and use. And let me clarify that the columns in black are USDA data, and those in red are from FAPRI, completed in August 2024. And what's interesting is that for corn, we've seen supply grow. It was not a record year in terms of corn production, but it was a very big crop with high yields although we had a smaller area planted. And also the demand side really grew from 2023, 2024, and we saw a big demand from feed use, ethanol, and other domestic uses, and even exports accelerated in 2024. The thing is, we started the year with a big beginning stock from last year, from 2023, and the demand grew more than the supply in this case, so the ending stocks declined a little bit. But this was a year of very big demand, very big supply, and with large ending stocks and lots of uncertainty in the world arena, the marketing year average price is projected at $4.10, much lower than the $4.55 from the previous crop year, right? And that's exactly what FAPRI was projecting in August 2024. So that gives us, an anchoring point for our discussions, how FAPRI is very close to USDA projections for 2024, 2025. So we can now look at the last column in this chart and see how much FAPRI is projecting in terms of additional production. We can see a growth there. And also in terms of additional consumption, feed use, exports are expected to grow. And ethanol is actually currently at very high levels. So there's not much room to grow on the ethanol demand. So with those projections, ending stocks are expected to grow not much by 4 million bushels, but that actually keeps marketing average prices at $4.13 for the 2025 crop. And that, of course, is bad news for corn producers, because that's a very low price, particularly when we take into account the costs of producing corn. The other major grain is wheat, and same thing here. We got USDA data and FAPRI data, and both production and the supply side and demand side have been growing. And the bad news is that the supply side grew faster than the demand side. So the ending stocks are growing through time. And with that, that puts a downward pressure on prices. And the marketing average price for 2024, according to USDA, is projected at $5.60, much lower than the $6.96 from the previous crop year. And FAPRI was projecting $5.66 for 2024-2025. Now, going into the next crop cycle, FAPRI is projecting a slightly lower production, a stronger demand for wheat, and a decline in ending stocks. So that should support somewhat higher prices, but still much lower than the 2023 and even much lower than 2022 prices. So again, bad news on the crop side. And if we look at prices, the historical series here, U.S. corn prices on the left and wheat prices on the right, and we compare USDA projections for 2024 with FAPRI projections, and then we add on top of that the December's futures prices for corn and the July futures for wheat, while the FAPRI and USDA price projections are very much aligned for 2024, and they kind of flatline after that at low prices. December's futures prices as of yesterday settlement price from yesterday indicate that those prices could be a little bit higher than what Fabry is projected, but not tremendously higher. So there's not a big disarrangement here or disagreement between Fabry projections and market projections. Those prices, if you see those lines with the triangles in the charts, those are not very different from Fabry projections, and they are still much lower than 2023 prices. And of course, several times lower than the 2022 prices when we experienced a spike in prices. What happened with soybeans? Well, soybean supply has been growing, very strong crop in 2024, big yields, a large planted area. On the demand side, we've seen domestic crush grow, exports grow, not to record levels, but still strong demand for exports. But ending stocks increased because of a larger supply than the domestic demand. And as usual, when ending stocks grow, prices usually suffer a decline. And USDA is projecting a soybean price of $10.20 for 2024-2025, while Fabry, based on an expected larger supply and a faster accumulation of ending stocks, Fabry projected, as of August 2024, a marketing year average price of $9.99 for soybeans. So there's a big, I would say, a substantial gap there of 20 cents, 21 cents. But still, that both price projections are much lower than prices in previous years. And moving into 2025, supply is expected to remain strong, with a little bit larger area and strong yields. So production will, remain about the same, a little bit smaller than in 2024, but still much higher than in 2023. And the demand side is actually expected to grow both from domestic crush, from higher exports, but the supply side is growing faster than the demand side. And according to Fabry projections, ending stocks would go up again. And that's bad news for prices. And that's why Fabry is projecting $9.65 per bushel of soybeans for 2025-26, which is a substantial decline from the $10 projected for 2024. When we compare USDA published prices and projections, Fabry projections, and market prices, these are November futures for soybeans on the left, we see that those are very well aligned and at very low levels, always floating around the $10 per bushel. On the meal and oil side, Fabry is projecting lower prices for both in 2025 and afterwards. And there's a little bit of a recovery by the end of the projection period, but that's 4 or 5 years ahead. And during this period, Fabry is projecting very low prices compared to the peak in 2022. And unfortunately, we have seen costs decline somewhat, but not at the same rate that we are seeing these prices go down. So cash receipts from crops, this is basically prices times sales of crops, we see that feed grains have already declined substantially. Oil seeds have declined substantially from 2022. And going forward, there's another expected decline in cash receipts from both feed grains and oil seeds. And it will take some time until those cash receipts go up again. But it will be challenging, to say the least, for crop producers. On the other side, cotton, sugar, food grains are seeing small variations, but there's not a big improvement on those crops either. Now, you might ask, okay, what's that other crops in this chart that are skipping this drop in cash receipts? Well, that's mostly specialty crops, nuts, and high value commodities that will retain or maintain the level of cash receipts observed in 2024 in the expected near future. But all other crops, most commodities, will go through a period of low cash receipts. On the livestock side, we've seen cow herd liquidation, beef cow herd liquidation, and it's the herd has been falling for a number of years now, since 2019, and FAPRI projects that the decline will continue until 2026. There's high profitability in the production system right now. It might, or most likely will, those margins will decline as we go through 2025 and 2026. But there's still profitability. There are some profits to be made in beef production. But this is the cycle we are looking at when we analyze the beef sector. As I said, prices are going up. Fed steers have seen increasing prices since 2020, and FAPRI projects another increase in prices for 2024 and 2025, and then those prices stabilize at a high level. So that's good news for cattle producers. The bad news is that feeder steers, right, are also going up in prices, so that shrinks the profit margin for those cattle producers that fatten cattle, and pretty much feeder steer prices are going up faster than fed steer, so that eats up some profitability from beef producers. But still, the business, as a whole, remains profitable in 2024 and 2025, and most likely in 2026. But that's not the case for all livestock. When we look at cash receipts from different livestock, hogs are pretty much stable, with stable cash receipts in 2024, but also going forward, it will take maybe a couple of years to see those cash receipts go up. Dairy products are likely to see a slight improvement in 2024, but then a small decline in 2025. And poultry and eggs, mostly eggs, have seen a spike in prices in 2024, related to the bird flu and some illnesses. But we don't expect that to really affect prices as much in 2025 as it did in 2024. So cash receipts are expected to go down for poultry and eggs in 2025. So as you can see from this graph, cattle is the big winner here in terms of cash receipts, and hogs is and dairy products are kind of stable going into 2025. And the sector that is most likely to feel a negative impact is poultry and eggs production. As I said, some production costs are declining, and here are some charts for diesel prices, nitrogen prices. These prices declined substantially from 2021 and 2022 to these days, but still they remain high in nominal levels. And if we look at the cost of corn production, of course, we saw a peak in 2022, 2023, and from that peak, variable costs have been declining, and Fabry projects that they will continue to decline, but we're kind of stuck with high costs. That jump from 2021 to 2022 is not disappearing in these projections. And these are nominal prices. These are not adjusted for inflation. So if we adjusted these numbers for inflation, then that jump, that gap between current costs and future costs versus the 2021 costs would be much higher, right? So fertilizer costs have been declining, and but at a much slower pace than what we saw the corn, soybean prices decline, and we expect those costs to remain high. So unfortunately, although there is expected a reduction in variable costs, it's not fast enough to compensate the decline in commodity prices. And this is not just for corn, but there are similar patterns for other crops. If we look at the composition of the variable costs, of course, we saw fertilizer costs jump in 2021 to 2022. And then we see the bar at the bottom going down slightly. Seed costs, not much of a change there. That category of costs is quite stable throughout. Fuel and electricity prices are kind of declining, but not very fast. So that's a stable category. And pesticide costs are not seeing much of a change. So after the observed decline in 2024 costs from 2023, Fabry projects additional reduction in variable costs, but at a slower rate. And eventually that will bottom up. And by 2027, costs are likely to start increasing again, even and this is in nominal prices. For livestock, we have this combination of higher costs for purchased livestock. So the cost of buying livestock has been going up, and that is not likely to decline for a number of years. But on the other side, feed costs, due to lower commodity prices and also some improvement in the In drought conditions, there's less drought in the Midwest, so there's more hay, cheaper hay available. So feed costs are expected to continue declining for some time, and these are opposing forces. So it's not clear up to what extent they will affect the entire profitability. But thing is, the margins, once we look at fed cattle versus feed and purchased livestock, the margins are likely to decline. Still positive, which is a big difference from what's going on with crops, but margins are likely to fall. Profit margins are likely to fall. When we look at the aggregate, the big picture, what FAPRI is telling us is that we've seen, of course, a spike in net farm income in 2022, and then 2 years of decline until 2024. This year, FAPRI was projecting a 6% decline in net farm income and an 8% decline in net farm cash income. And going forward, there's another year of reduction in farm income. FAPRI is projecting another 6% decline, so $8.4 billion decline in net farm income, and a 5.4% decline in net cash income, and that's equivalent to $8.3 billion. And the difference between these two measures is mostly depreciation, non-cash costs, and inventories, changing value of inventories. So not a pretty picture for agriculture going into 2025. And here's why it's so important to make good plans, to have a risk management strategy in place, make sure that you can, as a producer, you focus on your cash flow, making sure that you have access to good lines of credit if you might need some help with that, because it's very unlikely that, particularly on the crop side, we will see good profit margins. And compare this chart from FAPRI produced in August 2024 with this chart produced by the Economic Research Service on December 3rd, 2024. And they only project up to 2024, right? And they are currently projecting a slightly lower reduction, a slightly milder decline in farm income, a 4% decline in net farm income for 2024 with respect to 2023. And when we talk about net cash farm income, that's a 1.1% decrease projected for 2024. So a slightly milder decline in net farm income than FAPRI, but still it's a substantial reduction from the 2022 levels, right? And the trend is very similar to what we saw in the previous graph. So even if the numbers differ, the trend is downward, and that's of course concerning. Now, going back to FAPRI projections, what are the changes expected across different categories? So we already said that net farm income, the last set of bars on the right, is expected to decline by $9 billion in 2024 and an additional $8.4 billion in 2025 for the US as a whole. And most of that decline is driven by lower farm receipts, the first set of bars. that experience or were estimated to experience a 16.3 billion decline in 2024 and are expected to decline further by $18 billion in 2025. The full reduction in net farm income will be smaller than that because total expenses are expected to also decline in both years by $5.2 billion in 24 and by almost $10 billion in 2025. Now, government payments, which used to be, well, I wouldn't say used to, but they were a big component of net farm income in 2021 and 2022. Those, I would say 2021 mostly, those government payments are really small for 2024 and 2025, and there's not much of a contribution. If anything, the 2024 government payments are likely to be smaller than the ones received by farmers in 2023. So again, these are projections made in August 2024. And if we take into account the inflation projected over the next several years, net farm income, net farm income in nominal terms, not inflation adjusted, is expected to reach a higher level by 2026 than in 2024. And, about the same level in 2027 as in 2023. That's not the case if we look at inflation adjusted numbers, because for the entire projection period going all the way to 2029, the inflation adjusted net farm income is expected to be lower than the 2024 net farm income, which of course is much lower than in previous years. So that's concerning, and that's why, again, I have to insist on good marketing and risk management plans and good agronomic plans for 2025. Those are critical. Now, all these projections were made based on the status quo, on the current set of rules and regulations. With the change of administration, we don't know what the new Farm Bill will bring, whether it will actually happen in 2025. Recently, the House Committee passed a bill increasing the statutory reference prices for ARC and PLC, and also increasing the marketing loan rates. If that comes to pass as a law gets into the new Farm Bill, that could really improve the government payments, but we'll have to see. There's this question about whether there will be an assistance package before the next Farm Bill, and that might happen with a continued resolution that I will mention next. There's this expectation about tax credits for clean fuels, the 45C tax credit, and I will also mention briefly that topic in a minute. But those are things that could affect the income stream for crop farmers mostly. And we don't really know what the agenda of the new administration will look like. There are talks about extended tax cuts, new tariffs, and changing the regulatory agenda that might impact the agricultural sector. So we have to be paying attention to what's going on over the next few weeks and months. But particularly the congressional leaders agreed on a deal of a continuing resolution as of this Tuesday to keep the government funded through March 14, 2025, to extend the Farm Bill for 1 year. So that's good news. If it gets, of course, passed, and to extend ethanol E15 available at full fuel pumps all year long. There's language in that bipartisan deal to provide economic assistance to farmers and also emergency aid for communities impacted by natural disasters. And it also limits U.S. companies' investments in China that could harm national security and defense interests. But this is just a proposal for a continuing resolution by the congressional leaders on both sides of the aisle. We'll see if that's signed and approved by this Friday. The deadline is very short. But that might happen. And we don't know the exact details because this just came out and it's a 1,500 pages plus proposal. So Congress is going through all the details right now. Now, going to the carbon farming question, and I won't spend much time on this, but I want to give a framework so we can organize our ideas with respect to what are the different revenue streams that could be explored if a farmer is interested in participating in these carbon markets. And we have to remember that these are voluntary carbon markets in the United States. So there are multiple suppliers, multiple carbon initiatives offering different contracts. So and they have very distinctive and different approaches to working with farmers, to payments, to measuring the carbon sequestration and so on. But I just want to give a bird's view of what carbon farming entails for farmers. So there are basically, as I said, three sources of revenue: carbon offsets, carbon insets, and clean fuel tax credits. The typical buyers of carbon offsets are large corporations. The goal is to reduce the carbon footprint of that corporation. So we are talking Ford, we are talking Microsoft, we are talking Chevrolet, even the food companies, large food companies have pledged to become carbon neutral. And while they change their technologies to become to achieve those goals, they buy carbon offsets. Now, the farmer's role, if someone wants to participate, is to adopt some kind of conservation practice and reduce greenhouse gas emissions. Now, farmers are paid in terms of dollars per metric ton of carbon dioxide equivalent sequestered. And most of these companies require additionality. That means that if only new practices will be eligible for participating in these carbon offsetting programs. Most of the time, that's a requirement. So if a farmer has been doing no-till for 20 years, that no-till farm cannot be considered additional and cannot participate in this carbon offsetting program. The other major program that is growing very fast, also typical buyers are large corporations like Nestle, Unilever, PepsiCo, General Mills. They try to reduce the carbon footprint of a specific value chain or product. Think of low carbon intensity oats, for example. And here the role of the farmer is to implement the conservation practice, but the farmer does not really interact or is affected by how much carbon is sequestered in that contract. It's all about implementing a conservation practice, so the farmer gets paid in dollars per acre in the conservation practice, and additionality is not always required. So this is and a kind of an easier program to participate for some farmers, particularly for those that are not eligible for carbon offsets because they have been doing no-till and cover crops and so on for many years. Now, the newest set of the newest pathway to carbon farming is to produce low carbon feedstocks for fuel production. So low carbon corn for ethanol, low carbon soybeans for renewable diesel or biodiesel. And the driver of this new market is the federal government. U.S. Congress passed the IRA law, the Inflation Reduction Act, that would pay fuel refineries certain tax credits if they produce clean fuel, no matter what type of clean fuel. If it can be produced with less than 50 kilograms of CO2 per million British thermal units, then the fuel would be eligible for tax credits. Now, how a farmer can participate in these programs is by producing, as I said, low carbon intensity feedstocks, and we expect that payments will be related to the reduction in carbon intensity under certain industry average or certain local threshold. So the payment could be related to, could be expressed in dollars per kilogram of CO2 per unit of energy reduced. So those are the three main pathways to participate in carbon farming. And it's important to understand that these 45Z tax credits are paid to fuel refineries, not to farmers. And there's no clause in the law that indicates that the fuel refiners have to pass through a certain amount or a certain percentage of these tax credits back to the farmer. And so we have to be aware of that. There will be some kind of negotiation between farmers and fuel refineries. And the crop carbon intensity score is location specific, practice specific. So it's important to keep that in mind. And if the demand and supply in a specific area generates low price premiums for low carbon intensity feedstocks, then there might be insufficient incentives for farmers to actually participate in this market. What you can do now, if you are a farmer interested in looking into this, is run a quick and free carbon intensity assessment by going into the Ag Decision Maker file A178. That's a spreadsheet that my team developed a few months ago. It's currently published by Iowa State University. And that's a simple, very brief, it shouldn't take more than 5 to 8 minutes to run the entire assessment, explore programs and incentives, and consult with advisors, and stay updated on what's out there, because this is a very dynamic space. And with that, I want to thank you for your attention and hope we can have an interesting discussion with the Q&A in a minute. Please feel free to scan this code and receive the latest RAF updates in your inbox.
Great. Thank you, Alejandro. Let's go ahead and turn it over to Austin. He's going to talk a little bit about the carbon program at ForGround.
I just want to take a couple minutes here. This is literally only going to be a few minutes. I'm going to kind of go through these slides kind of quickly. But again, Austin Omer with the Bear Carbon Program here. Just wanted to talk a little bit about a couple of those different programs that we have that Dr. Plastina did a great job of explaining the difference in those types of programs, and just kind of talk a little bit about what we have going on, and then we'll get to the Q&A. And so The 2024 Bear Carbon program, we expanded it quite a bit. It includes payments per an acre basis, not based on how much carbon is sequestered, for cover crops, no-till, strip-till, and we've really expanded it to 26 different states. It used to just be corn, soy, and wheat, but now we've also got many other small grains that you can see on the slide there included as well. We've also shortened our contract length and really tried to simplify some different things, while also including as many different types of farming systems as we can model and therefore include in our program. So we really wanted to try to be less exclusive and more inclusive when it comes to our program for 2024, and we will continue to work on that into 2025 as well. And so what our payments look like is currently we pay $6 an acre for no-till or strip-till and $6 an acre for cover crops. So could be a total of $12 an acre if you're doing both of those practices. And then we've also got a historic look back period, and this gets a little confusing, but we can include growers in the program and fields in the program in which you started strip-till, no-till, or cover crops in the last 5 years. So fall 2019, if you started fall 2019 or later, we can get you included in the program and you're eligible. And then what we can do is we can actually go back and pay you going back to 2020. Now, starting January 2025, we'll only be able to pay you going back 4 years to 2021. And so we do have that historical payment, which can add up pretty quickly for those fields in which you've been doing the practice on for the last 3 or 4 years. We also have right now an enrollment bonus. We're working with the Mars Pet Nutrition Company that sources a lot of grain. Going back to what Dr. Plastina said, as far as, a company that's working on their insetting, and we are helping them to stack their program on top of Bear Carbon's program to help them inset their supply shed in Nebraska, Iowa, Illinois, Minnesota, and Wisconsin. So we do have in 2024, if you enroll by the end of the year, we will get you a payment of $10 an acre for cover crops and $10 an acre for no-till or strip-till, and that is on corn, soy, and wheat rotations. And again, just a couple things that I mentioned to a lot of different growers that talk to us about these programs is one, I encourage growers to take advantage of this marketplace right now. We've had a lot of interest in our program. Mostly due to what Dr. Plastina has talked about with commodity prices and budgets being tight. But I encourage growers to one, do some homework, reach out to us, talk to us about the program. Also talk to us about other programs that are compatible and how you can maybe stack some different programs to take advantage of the marketplace and try to get as much value out of the marketplace and resources as possible to do these practices and cover the cost and risk of these practices. And again, we pay based on practices and not based on how many tons of carbon you sequester. We try to take the risk out of that for the grower. Our program we try to keep it as simple as possible. And really it takes maybe a couple hours a year to take part in our program. We come out, sit down with you, collect the information we need from you in order to model your system on your fields. And that's pretty much the amount of work that is involved to take part in the program. And again, flexibility is a big one for us. We try to be flexible as far as growers coming and going from our program. We try to be flexible as far as the fields that are enrolled and removed from our program. And we understand farming happens as far as if you have to till a field for 1 year, something like that, we can work with you and we don't necessarily have to remove that field from the program. So again, that flexibility is a big one for us. We try to keep the program as applicable as possible to as many farms as possible. And then the last thing I'll mention there is that historic payment, right? We have really focused in 2024 on trying to get as much value out of this marketplace to different growers as possible. And that includes that historical payment. And it also includes on advising growers on programs that are compatible with our program as well. And again, it's all about being there for the grower and trying to get as much value out of the marketplace as possible. The last thing I'll mention here just briefly is Dr. Plastina talked a lot about economics. I talked about payments, right, for our carbon program and our partners' carbon programs. there's more than just economics to some of these regen ag practices and some of these conservation practices. So, it's in my mind, it's about both sides of the balance sheet, right? It's also about reducing your cost and inputs, right? While also coming up with some additional revenue opportunities on the other side of the balance sheet. But some of these practices really have a lot of benefits to them that are hard to put an economic value to or in externality, right? And so that includes, holding more water and nutrients, improving infiltration, controlling weeds during different times of the year, and really reducing that nutrient loss as well, reducing erosion. So a lot of those things are kind of hard to put a economic value to, but we are seeing that with a lot of these practices and a lot of farmers that enrolled in our program. We talk quite a bit about that. And so I'll just leave this slide up here for now and keep sharing. But I do encourage you to reach out to Dr. Plastina. His website is there on the bottom right, the rural and farmfinance.com. I've used some of those FAPRI resources before, and Dr. Plastina has done a great job of making it super simple with some dashboards and things like that to really see what some of those farm outlooks and incomes will be into the future. And so with that, John, I think we could take some questions.
Great. Thank you for that awesome explanation and all that information. We do have some questions that have come in, so let's go ahead and get to it. Chet asks, if we have been doing cover crop and no-till prior to 2019, are we eligible to enroll in the early adopter program? That'd be question to Austin.
Yeah. So currently you would not be eligible for our program, the way our program is set up now in our current model of our program. But going back to what Dr. Plastina talked about in his last couple of slides there, I think on that last column, right, when we start to talk about carbon intensity scoring programs, there's no additionality requirement, no look back requirement for those programs. And so what we'll see into the future is we will see those longer term adopters will be eligible to take part in this marketplace when we get those new models of programs essentially rolled out. And I would, I'm not going to promise anybody anything, but I would say we'll see those coming probably in 2025, 2026. I don't know, Dr. Plastina, if you want to add to anything I said there, but.
Just indicate that the Biden administration published an announcement last week or maybe 2 weeks ago saying that the rules and regulations for the 45Z tax credits will be available before the change in administration. But, that's a big question mark at this point.
Great, thank you. There are a couple other important questions that came up here. One of them is, does enrollment in your program affect my 45Z eligibility with an ethanol plant?
Yeah, so we're currently, I'll pass this one over to Dr. Plastina too for his input on this as well, being linked into the policy world like he is. But I would say that currently we don't really know, to be honest with you, what the rules on the 45Z are going to be and what the compatibility looks like. However, I would say that as far as the carbon intensity scores not having that additionality requirement, I would suspect that taking part in a current carbon market opportunity would not prohibit you from taking advantage of those carbon intensity scores into the future, those type of programs into the future. But again, I haven't seen any guidance on what that looks like. Dr. Plastina, I'll kick it over to you. So.
Yeah, thank you, Austin. I agree with you. We don't know what the final set of rules and regulations will require. But, just speculation on my part, I think that if you participate in an offsetting program, since you are selling the carbon sequestration as a separate asset from the feedstock, you might not be able to stack those payments. But that's, again, just speculation on my part. If it is in setting where you get paid to do conservation practices on a per acre basis, I think there should be room to stack those payments to participate simultaneously on the insetting program and the 45Z credits. But again, that's speculation on my part.
Great. Thank you, Alejandro. Bruce Knight asked this question. Austin, can a farmer stack climate smart projects enrollments from the USDA with ForGround?
So currently, it really depends on the project. Okay, and I'll give some guidance on that. So currently, if that climate smart project has a carbon market opportunity associated with it, and you're getting paid for the benefit or the carbon you sequester, we are not compatible or stackable with that opportunity. However, we do have guidance out of the 2018 Farm Bill and also guidance from USDA over the past year or two that we are compatible with like your classic EQIP or CSP type programs. So it's very project specific. We are also compatible with like research projects, soil health projects, watershed type payments and projects that come out of NRCS as well. Like we're compatible with a lot of those different projects, but typically if it is another carbon market program, we are not compatible and you cannot stack our program on top of that.
Yeah, one additional question from Bruce. Is rye or wheat to be harvested for forage following corn silage considered a cover crop in ForGround's program?
So it is not considered a cover crop in ForGround's program. If you harvest that winter oilseed or whatever it may be, we no longer consider it a cover crop, and we've kind of gone off of, to date NRCS kind of definition of what a cover crop is. And that's typically what our registry uses for a definition of a cover crop. And when you go to harvest that, it's no longer considered a cover crop. Dr. Plastina, do you have anything to add to that as well?
No, that's right. That's a new regulation that came out in May 2024. So that's important to know that you cannot harvest cover crops as in the past.
Right. Austin, someone asked if there's an established payment plan for biochar practices.
We do not currently have biochar practices in our program, or it's not really, I would say to date, it's not on our radar to add biochar. It's something that we could probably look into, but it's definitely not on the plans for 2025. I can tell you that. Dr. Plastina, I don't know. Do you know of any? I don't know of any programs out there that would have like a biochar component to it. I haven't heard of any, but.
No, I don't. I haven't heard of any either. There are specific climate smart programs, funded through USDA grants that are exploring the potential to use biochar to improve soil health and sequester carbon. And those who participate in those projects, applying biochar into their farms might be getting payments through those programs. But I don't think I haven't heard anything of a commercially available program for biochar right now.
Good. Thank you for that answer. I think we got one more question or clarification. Bruce Knight said he was talking about haying, not oil seeds. So I don't know if that changes the answer. But
so currently we do not allow you to go in and bale a cover crop for like rylage or something like that. We when you remove essentially that carbon from the soil surface, we consider that income coming from that property. But also we have a really tough time modeling that as well, because we would essentially need to collect essentially the biomass and the tons that you remove from that property. So currently in our program, we do not allow you to essentially bale or harvest that cover crop in any way. However, there may be other programs, I don't know of any, that might allow you to do that. So I'd encourage you maybe to reach out to some other folks, or reach out to me, and I'll try to put a small list of other programs together that you could reach out to and check into. to see if they allow that. So.
Well, great. Well, we've come up on the hour, and I think we're about out of time for today. Want to thank everyone for those great questions and the great answers that we got. For any questions that came up that we weren't able to answer, we're going to get these over to our panelists, and we'll make sure those questions get answered, and we'll email a response to you. Just as a reminder, today's presentation and audio will be made available on the No-Till Farmer website. If you'd like to review what was talked about today or show it to any of your colleagues, neighbors, or anyone else, you also receive an email within 48 hours of the recorded presentation, so watch your email for that. On behalf of ForGround, our speakers today, and No-Till Farmer, thank you for joining us for today's presentation, and enjoy the rest of your day.